Hi friends, this video may generate a lot of hate comments for me, but I am not worried at all about the trolls because I will speak data and facts on this video. First data point is that if you go to IIM Ahmedabad's website, you will see that their fee for a 2-year MBA program called PGP is 25 lakh rupees, and this does not include the living expenses such as onboarding, laundry, etc. So for 2 years of program, if you add another 3 to 4 lakh rupees, it is going to easily cross 30 lakh rupees. Now this is not just the case with IIM Ahmedabad. If you go to this website, what you are going to see is the fee structure for 24-26 program, and you see all these IIMs are charging somewhere between 18 lakh rupees to 26 lakh rupees excluding the living expenses. Finally, if you see this snippet, you will see that back in 2007, IIM Ahmedabad used to charge 4 lakh rupees, that is now costing 27 lakh rupees as of 2023. And if I do some calculations of CAGR, you will see that in these 16 years, these 4 lakhs have gone to 27 lakh rupees, and that comes out to be 12.68% of CAGR, meaning every year the rate that IIM Ahmedabad has increased in the last 16 years, it is actually 12.68%. Now you will say that Rahul, you are cherry picking some of the IIM Ahmedabad. IIM Ahmedabad or IIMs in general does not represent the entire education sector. Fine, I agree with that argument. Have a look at this data published by CNBC. Here CNBC is talking about general inflation being 5 to 5.5%, while the education inflation has been around 11 to 12%, and this data is as of April 2024. And again, lastly, if you do not believe me, do your own research and you are likely to conclude that the inflation rate when it comes to education cost is much higher than general inflation rate of 4 to 5%. Now tell me, how many of us are getting a salary hike after tax being 12 to 13% every single year? I don't think many of us are able to do that on a consistent basis. And the reason I have shared this data with you is that if you're only relying on fixed deposit as a method of saving your money for future education costs for your children, then 7 to 6% interest rate, and if you take the tax out of it, it might be 4 to 5%, is hardly going to beat the general inflation rate. It can never beat the education inflation. In fact, you are losing money because if you're doing FD at 7% and the education inflation goes by 12% or 11%, you're easily losing 4 to 5% of your money on a single year basis. So the point I am trying to get to is that if you are saving and investing for your child's education, try to look for a long-term horizon of investment and try to generate minimum 12% of returns on the money that you're saving and investing for your child's education. Now, some of you may argue that, Rahul, we want to send our kids to foreign universities where the inflation rate is not like 10% or 11%. Here are two critical facts that you need to know about foreign universities. Point number one is, have a look at my screen, and this is the cost in US dollars if you want to send your kids to US universities, and you see that tuition fee itself is around 20 to 50 lakh rupees. So point number one is the base fee of US universities is extremely high depending on the program that you choose, and moreover, if you see the living expenses here, it may be around 10 lakhs to 12 lakh rupees per year. So for a 2 years course, it is roughly going to be 20 lakh rupees to 30 lakh rupees easily for 2 years. And if you sum all these expenses that you see on my screen, it is going to be easily 50 lakh rupees to 2 crores depending on the university you want to send, depending on the course that you select. My point is very simple. The base cost of foreign education right now itself is extremely high, 4 to 5 times higher than what we have in India. And on top, point number 2 is the rupee depreciation. What you see here is that in 1984, $1 used to be around 11 rupees 36 paise, but in 2024 it has gone up to 83.14 rupees. And if I do some calculations, you will see that in these 39 years, rupee has depreciated almost by 5% every single year. Now in future, will rupee continue to depreciate or appreciate? I can't predict that, but when we are planning our funds for future, we have to consider this depreciation rate as well. On top, if I look at the inflation rate in US for education, you will see that depending on whether it's a private 4-year college or a government-based college, it might be somewhere around 3 to 4% easily. And if you add rupee depreciation of about 5%, easily it is going to be 8 to 9% of inflation when it comes to foreign universities in my view. What I want to quickly conclude here is that the cost of education and how it grows up in the next 10 to 12 years is not in your hand. What is in your hand is to plan and invest your money in such a manner that you are able to beat the education inflation cost. Now the million dollar question is, Rahul, how much of money we need to save for our kids' education for future? And I can tell you that there is no correct or wrong answer here, because it depends on many things in terms of what your kid is likely to do in the future. Are they going to study in India? Are they going to go to a foreign university? And so on and so forth. But in my head, the way I am calculating is that I am going to need to enroll for a course that is right now costing 25 lakh rupees roughly, because I need a starting point to do some calculations. And if I use 12% inflation rate and I calculate 20 years of time horizon, it comes out to be this 25 lakh rupees of cost that I have to incur right now is going to be somewhere around 2.4 crore rupees. Now all of us may not need 2.4 crore rupees of money, because it depends on what the age is right now for your kids and where they want to pursue the education. But in my head, the calculation I am doing right now is that I am going to need minimum 2.5 crore rupees of fund for one of my daughters. Rahul, 2.5 crore is a lot of money, and how to go about saving this money? So in my view, very sensible goal-based SIP is what you need to think about. Have a look at my screen and you will see that if you do a 10,000 rupees per month SIP, that is a minimum in my view that we need to plan for. 10,000 rupees of monthly SIP, and if you do an annual step up, meaning increase it every year by 10%. So the next year it becomes 11,000 rupees per month, right? And so on. So 10% of annual step up, 12% of expected returns is what you need to shoot for, which is not very difficult if you're planning it for 20 years of time horizon. Starting early here is the real key that people are missing out on. Therefore, if I do the calculation, it comes out to be you are likely to have 1.98 crores pre-tax of a corpus that you are going to build in the 20 years of time horizon. Now let's say the capital gain tax remains 10%, which I highly doubt in the 20 years time period they will remain 10%. In my view, they are going to go up. But for the calculation purposes, let's assume that it is going to be 10%. That means this will likely to become 1 crore 85 lakh rupees in hand for you. And in my view, the remaining money you can consider taking an education loan at that particular time, because 10,000 is the minimum you need. But if you can do little more, right? If you can plan for, let's say, 15,000 rupees per month with a 10% annual step up, 12% returns for 20 years is likely to give you 2.98 crore pre-tax. And in my view, this framework of 10,000 to 15,000 rupees per month goal-based SIP can take you anywhere between 1.85 crores to somewhere 2.5 or 6 crores after tax, which is what you essentially needs. See, this is just a framework. Please consult with your financial advisor, because I'm not a financial advisor. All I'm doing is I'm sharing with you how my mind is working for my kids' education. And if you're liking this sort of analysis, hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. With that, let's move to the million dollar question that, Rahul, how do we start SIP? Where do we put this money? Where is the opportunity really? So I'll speak about few asset classes broadly without giving you any recommendations. Number one is fixed deposit. In my view, that's a big no, because you're only going to gain 6 to 7% interest rate, and on top of that you will have to pay tax based on your slab like 10%, 20%. So in my view, that is only going to give you 4 to 5% of gain. That's a completely waste, because it will not beat the education cost inflation. So let's start with good options. Number one is Sukanya Samriddhi Yojana. I did a comparison of Sukanya Samriddhi Yojana with mutual funds in one of my videos. You will find that on the channel. Here, the key point that you know is it's only for the girl child, but it gives you tax-free returns. So if it is giving you 8%, because every quarter the interest rate will change between 8%, 8.5%, it gives you tax-free money. So definitely you can consider that one of the options. You don't need to put a lot of money into it, because anyways there is a limit. You might give some money into this so that you have assured guaranteed returns coming into your pocket. However, personally, I am not putting my money into Sukanya Samriddhi Yojana, because I am very confident that I can easily beat 8 to 9% of returns anytime, even using mutual funds and stock. That's why I created that particular video, and I publicly said that Sukanya Samriddhi Yojana is not for me. It is only for risk-averse investors who want to have guaranteed returns without paying any taxes. Now, let's move to the mutual funds. Mutual funds sahi hai, sahi hai, sahi hai. Yes, it is sahi hai, but which one is sahi hai? So for that, many people are unaware there are child-specific, solution-oriented mutual funds out there in the market, and you can easily find them. If you go to this website tickertape.com, you are easily going to find the mutual fund screener, and simply click on solution-oriented children's fund, and you are going to get a list of these. None of these are recommendations. I am only giving you a concept here, and why these solution-oriented mutual funds are a good option is what I need to explain you. Let me pick up an example of SBI Magnum here. Again, it's an example. I am not giving this as a recommendation. If you download their brochure from their website, you're going to see 3 to 4 interesting facts about how the solution oriented mutual funds are put together, right? So for example, if I come down here, one of the things you will see is that the sector allocation, and you will very quickly notice that these monies are parked in evergreen sectors more or less. So financial services, banking, consumer durables, capital goods, healthcare, FMCG, IT, these are all evergreen sectors in my view. And just because one needs this money, definitely after 10 years, 15 years, 20 years, the mutual fund managers are not going with cyclic or thematic based sectors like railways, for example, or defense, because they are in massive bull rally right now. But what's the guarantee after 3 years that they will continue to be in the bull rally, right? So therefore, these solution oriented funds invest their money into evergreen sectors. Point number 2 here you will note is the allocation across multiple assets. And if I show you, they not only invest in the stocks, they also invest in foreign equity shares. So for example, here they've got Google and Netflix stocks in the assets. They've got ADRs as well. They've got government securities and T-bills as well. So there is a slight diversification done for you automatically so that you don't need to worry about that. Point number 3 you will notice is that there are always exit loads in here, and these exit loads are higher than the normal mutual funds because they will stop you withdrawing the money that you're saving for your child's future. Extremely important point that you will note in such funds. Point number 4 you will note here is that the fund managers that you see here, there are multiple fund managers here. So for example, one of them is taking care of the equity portion. Second one is looking after the debt portion of the assets. Third one is looking after the overseas investments, right? So there is a holistic fund management that you are seeing while you're paying the money expense ratio, which is generally higher in case of the solution oriented mutual funds. As you can see here, it might vary from 0.85 to almost 2% depending on the fund that you're going with. So far, if you're liking this video, hit the like button. Also, you can consider subscribing to my YouTube member community where I share the in-depth analysis exclusively for my YouTube members via posts, and you're going to learn a lot about various assets like mutual funds, stocks. You will find the link in the description or in the pinned comment, or simply go to my channel and click on the community tab and just press on the join button and follow the process. Now moving on from solution oriented mutual funds to normal mutual funds, which are equity based mutual funds. You might have a natural question, Rahul, can I go for small cap mutual funds or mid cap mutual funds for a 20 years of time horizon? My suggestion there is that try to look for ELSS mutual funds. I created a separate video on ELSS mutual funds, and the reason I like ELSS mutual funds for planning for your child's education is because of there's a lock-in period. Right now it's a 3 years lock-in period, and that will make sure that if you're itching for unnecessary reason to withdraw your money, at least for 3 years you're not going to touch that money. And also it gives you tax benefits if you're in the old regime. So all in all, ELSS mutual funds make a very good candidates when it comes to planning and saving for your child's education. Lastly, what about stocks, Rahul? Can I invest in stocks when it comes to planning for my child's education? See, the answer is yes and no. First of all, you must be a good stock picker if you want to invest in stocks for your child education. Secondly, only try to pick up those stocks that are belonging to evergreen sectors, right? Don't go for thematic or cyclic stocks, because it might happen that right now for the next 2 to 3 years, you might see a massive bull rally in the stocks that you're picking, but after 5 or 6 years, it might correct heavily. So don't go for cyclic stocks, go for non-cyclic stocks, evergreen stocks. And I've created a lot of videos on my channel talking about a lot of stocks. Consider subscribing to my channel and press the bell notification so that every time I post a video, you're likely to get the notification and watch the video. You're going to learn a lot through those videos itself. Now, I have spoken for the last 15 to 17 minutes. What I want to know from you is, what is your goal? How are you thinking about your child's education? Let me know in the comments. Are you doing SIPs, for example? Have you got any specific mutual fund categories that you're looking for? I'm here to listen to you, read your comments, learn from you as well, and improve my investing style as well. With that, I hope you enjoyed this video. I'll see you in my next video. Until then, keep rocking.